How would the introduction of CBDCs affect DeFi? What are operational angles and areas that CBDCs could disrupt in the DeFi industry? Let's find out. After nearly a decade on the sidelines, governments led by their apex banks are now preparing to plunge into the blockchain space with central bank issued digital currencies. From barter to banknotes and now to Bitcoin, humanity's systems of value exchange and transfer of assets have been dramatically transformed over the past 2 centuries. Today, the advent of cryptocurrencies and blockchain technology further underlines our innate need to carry out transactions and access essential financial services ever more efficiently. At its previous all-time high global market cap, which was just north of $3 trillion, if the crypto industry were a country, it would be the 4th largest economy in the world. The potential systemic effects and far-reaching benefits of decentralized finance mean that government intervention in the sector is becoming inherently inevitable. In April of 2020, People's Bank of China issued the e-CNY, or digital yuan, becoming the world's first large economy to test run the much anticipated central bank digital currency, or CBDC, in a highly successful, albeit relatively unpopular pilot program that covered over 25 million Chinese citizens. Since then, more than 90% of countries around the world have since initiated legislative efforts to introduce their own government-backed cryptocurrencies, as reported by the Bank of International Settlements, or BIS. So let's start with what is a CBDC and why have they suddenly become necessary? So in technical terms, CBDCs are central bank digital currencies, and they are the digital units of money issued by the government of a sovereign country, typically leveraging the use of web-based technology systems, i.e. blockchain technology. They are essentially a digital or crypto version of a country's fiat money or legal tender. Amid other factors, the rise in the popularity of blockchain technology, cryptocurrencies, and decentralized finance have coincided with a sharp global decline in the use of cash for payments globally. During one of the infamous crypto boom periods between 2013 and 2018, the volume of cash transactions declined by approximately 70% in the UK, from £20 billion in 2010 to £6 billion in 2022. And within the same period, average Bitcoin trading volume on UK exchanges rose from around 100,000 to £15.5 million. This decline in cash transactions is expected to be exacerbated even further in the coming years. Evidently, as the mainstream adoption of cryptocurrencies grows, especially in developing economies, countries are anticipating further decline in the use of physical cash or paper money. Consequently, governments around the world have been contemplating ways to create digital channels for issuance of money and regulation of financial transactions in order to retain their supervisory role and sovereign control of their respective financial jurisdictions. And CBDCs present the perfect en route for government participation in the nonsense alternative, the blockchain space. CBDCs' common characteristics. For most countries today, CBDCs remain at the ideation stage. This makes it quite difficult to understand exactly how every nation would structure theirs, and if monetary policy variations and global socio-economic landscape is anything to go by, it is expected that CBDCs too will take on different outlooks in terms of design, interlopability framework, and technological deployment mechanisms from one country to another. However, drawing inferences from countries like the Bahamas, the Sand Dollar, or Nigeria's e-Naira and China digital yuan, who have successfully launched their own digital currencies, we can identify the following 5 crucial characteristics that differentiate CBDCs from other forms of cryptocurrencies. A digital currency, non-cash balances recorded as a store of value and used for payments across digital channels. Legal tender, issued and backed by the central bank and or monetary policy authority within a given sovereign geopolitical jurisdiction. Universally accessible, accessible to users, i.e. residents and non-residents, for cross-border payments and settlement of transactions. Registration and KYC. To obtain CBDCs, users would have to provide basic biodata to register and open an account either directly with the central bank or authorized counterparties. Surveillance and censorship. Most CBDCs will be subject to monitoring and censorship by the issuing governments. And similar to TradFi bank accounts, CBDC users may have access to their balances restricted or withdrawn where they, beneficial holders, are found to be infringement of certain laws. What are the areas that CBDCs could affect in DeFi? Well, unsurprisingly, the introduction of CBDCs have led to the ideological dissonance among blockchain maximalists and stakeholders around the world. While there are staunch critics like Edward Snowden who tagged them as crypto-fascist currencies that would annihilate savings of the average worker, other prominent DeFi proponents like Vitalik Buterin sees government participation in the form of CBDCs as a welcome development that would lend some credence, legitimacy, and sanity to the DeFi world. In 2020, the Ethereum founder showed support for CBDCs when he shared a tweet that showed some of the interesting use cases if governments are able to make CBDCs transparent and interlopable within the framework of existing blockchain networks. However, this has not stopped the raging debates and threats about stifling regulatory oversight, censorship, and centralization, which are antithetical to the core pillars of decentralized finance, as well as the potential impacts of CBDCs on the long-term viability of existing DeFi protocols. Hence, to objectively weigh the merits of both arguments, it is crucial that we analyze the areas of potential synergy and dissonance between CBDCs and DeFi. These key areas include stablecoins, on and off ramping, DeFi investing and yield farming, security and privacy, talent attraction. So number one, impact of CBDCs on stablecoins. For any system of value creation and exchange to thrive, there must be a universally accepted unit of account. And up to now, stablecoins have played as the unit of account role in decentralized finance, similar to the role that fiats play in the stock exchange and money markets. Essentially, this role allows investors and users to switch and swap efficiently between different digital assets without having to off-ramp back into fiat. Basically, stablecoins have three broad use cases in DeFi: payments and remittances, volatility hedging, and on and off ramping. CBDCs could disrupt each of them to varying degrees, as they generally would seek to mirror these roles. So let's just have a look. Number one, payments. In addition to being a reference point to benchmark DeFi products and services rendered on the blockchain, stablecoins also have the primary role of money. As the standard medium of payments and exchange, stablecoins enable crypto users around the world to sidestep the existing SWIFT system, making instant payments as they conduct borderless transactions without having to wait 5 to 10 business days or having to pay 5 to 10% in bank charges and conversion fees. By offering instant settlement at a near zero remittance cost, stablecoins have increasingly become a widely adopted medium of payment in international trade. According to data cooled from crypto payments provider BitPay, Bitcoin's share of payments slid from 92% in 2020 to about 65% in 2021, with the adoption of stablecoins, i.e. USDC and USDT, rising sharply of around 13%. While some countries like El Salvador are embracing the use of cryptocurrencies, i.e. Bitcoin, most nations around the world are reluctant to relinquish their monetary sovereignty. Hence the accelerated introduction of domestic digital currency to mirror, replace, or rival the role currently played by stablecoins in the crypto economy. So what has been termed by international organizations as the Bitcoin experiment is nothing more than the world watching how mass adoption changes as a country's economy. In terms of efficient payments and remittances, CBDCs will offer stiff competition to stablecoins in the following areas: reduction in demand for stablecoins. If CBDCs offer some of the core properties of stablecoins, such as ubiquity, security, on-chain validation of payments with instant settlement, they could negatively impact the demand for stablecoins in terms of international payments. Reduce domination of the US dollar. Today, stablecoins are only available in only a handful of fiat currencies, with the US dollar dominating the stablecoin market, offering by well over 90%. All of the top 10 ranking stablecoins by market capitalization are denominated in US dollars. The introduction of CBDCs could potentially cause a major disruption in this regard, with 90% of countries, including large economies like China and the EU, launching on-chain government-backed digital currencies. We could witness a significant reduction in dollar domination of the stablecoin market. Number two is volatility edge. Another key function of stablecoins is to serve as a neutral vehicle for users to shelter their on-chain assets against volatility. In spite of the significant growth in adoption, the public perception of the reliability of stablecoins has come under intense scrutiny in recent times. Some landmark events have shown that stablecoins carry significant depeg risk. Algorithmic stablecoins specifically have quite deservedly gotten a bad rap, from the iron finance crash in June of 2021 to the catastrophic $40 billion Terra USD capitulation in May of 2022. Likewise, key stakeholders and blockchain industry experts have also grown wary of collateralized stablecoins issued by private entities due to ambiguity and lack of transparency of reserve assets. This led to Tether-issued USDT, the leading stablecoin by market cap, wobbling below 95 cents in the aftermath of the Terra USD crash. With national deposit insurance, tax incentives, and other monetary policy incentives, CBDCs could offer better stability and reliability to users, especially for institutional investors who invest high-volume on-chain assets. And this could lead to a drop in circulation circulating capital of prominent stablecoins. Number 2, the impact of CBDCs on and off ramping. The death of on and off ramping methods is a key factor that has slowed down the mainstream adoption of cryptocurrencies and DeFi products globally. Today, stablecoins currently serve as the easy route for many new users to on-ramp into the crypto world and also off-ramp back into desired fiat currencies. Since they are denominated in familiar fiat currencies, they offer transactional simplicity. However, due to the fact that the prominent stablecoins are denominated in only a few fiat currencies, such as USD, Euro, SGD, Won, etc., it creates transactional bottlenecks for users in other countries around the world. The introduction of CBDCs in many countries could then significantly disrupt the current on and off ramping methods in DeFi. CBDCs may unseat stablecoins to emerge as the default on-ramping route. Due to the fact that they are national currencies, users may find it easier to on-ramp and off-ramp with CBDCs, as they could offer a more seamless interface with domestic banking systems. CBDCs may lead to a wider adoption of cryptocurrencies for sanctioned or red list countries who are excluded from the SWIFT network and developing countries with less sophisticated international banking systems. The process of purchasing cryptocurrencies, NFTs, and digital assets is often fraught with many bottlenecks, i.e. inefficient local payment methods, local cards not accepted on centralized exchanges, etc. With the introduction of CBDCs, residents of such countries will now have an effective and reliable on and off ramp, thereby boosting retail and institutional participation in DeFi within those regions. Number 3 is the impact CBDCs on yield farming and DeFi investing. The blockchain world has grown rapidly into a multi-sector industry. According to DeFi Llama, a leading blockchain analytics platform, yield farming is by far the most valuable sector within DeFi, with nearly $100 billion total value locked in different DeFi protocols. Yield farming is a novel process that allows users of DeFi platforms to maximize returns on their digital assets. In practice, users deploy their assets on platforms like Maker, Comp, etc. to lend or borrow crypto assets in a bid to earn passive income. For CBDCs to disrupt this largely decentralized world of unique financial products and passive income opportunities from yield farming, they must offer some type of utility and interlopability within this existing blockchain infrastructure. CBDCs are going to disrupt the crypto world to a significant degree. However, the level of utility of these on-chain government-backed currencies are still very much up for debate. Yield farming requires a high level of agility in the infrastructure of crypto assets. To maximize yield, users need to be able to move their assets efficiently and securely between different DeFi protocols. With indications given by central banks, it is obvious that governments face a trade-off trilemma when it comes to their active involvement in the blockchain space. These trade-offs include macroprudential control, interlopability, and utility. The design trade-off essentially means that governments have to choose between having CBDCs achieve a significant degree of penetration in the yield farming sector or maintaining 100% sovereign monetary controls by attempting to localize the functionalities of digital currencies in a largely ubiquitous world of CBDCs. Some people speculate that CBDCs are only the first step of a full-scale government participation in the blockchain space. The introduction of CBDCs effectively clears the coast for the digitization of bond markets, where governments may trade bonds and treasury bills on the blockchain. Since government-backed assets generally offer a more reliable yield-bearing option, especially for large institutional investors, a transparent, instant, and liquid bond market that is open 24/7 would pose serious competition to existing yield farming strategies. Number 4 is the impact of CBDCs on security, privacy, and censorship in DeFi. The architectural and functional design of a CBDC is expected to allow central banks and regulators to impose stringent KYC requirements and transactional restrictions. These transaction limits can range from constitutional macroprudential standards, including anti-money laundering and anti-terrorism financing, to arbitrary rulings and autocratic regimes. Conversely, since all transactions are traceable and verifiable with a distributed ledger technology, the data generated by CBDCs would also offer new levels of transparency and fraud prevention, making it easier to monitor retail transactions and detect unusual payment patterns. Some of the biggest criticisms of decentralized finance today include security vulnerability and a non-existent mechanism for legal recourse against bad actors, i.e. hacks, proprietary trading, over-leveraged trading, and other forms of unethical fund management by DeFi protocols. Blockchain users could face a trade-off between the semblance of safety that CBDCs could offer and the anti-censorship and privacy of DeFi. In addition to the introduction of CBDCs, many governments around the world are simultaneously working to standardize laws to prevent regulatory clarity on cryptocurrencies. These laws seek to distinguish between between pure utility tokens and tokens that function as securities in a bid to create a standard mechanism to enforce compliance in corporate governments in blockchain markets. The catastrophic capitulation of centrally controlled CeFi platforms that act as a DeFi liquidity provider like Celsius, Voyager, and Three Arrows Capital in the wake of the Terra UST crash further highlight these gapping flaws. Many users have had to turn to traditional legal frameworks to gain some recourse against the founders and top execs of these platforms. This could impact the demand for DeFi products among institutional participants and retail users who are risk averse, causing them to gravitate towards CBDCs and other forms of legally backed and secure on-chain assets. Transactional restrictions and KYC requirements are two distinct design features of CBDCs, and these features are antithetical to the premise behind the creation of cryptocurrencies as outlined by the framework by Satoshi Nakamoto in the original Bitcoin white paper. Recent high-profile censorship concerns include the restriction of GoFundMe accounts linked to truckers protesting vaccination mandates in Canada, restrictions of bank accounts, and end SARS protesters by the Nigerian government, as well as the freezing of assets belonging to the protesters in Hong Kong in December of 2020. This censorship could actually see many retail users and Bitcoin maximalists not liking the use cases of CBDCs. Even when they use CBDCs for efficient on-ramping and local retail payments, most privacy-sensitive users may choose to dump CBDCs and turn to censorship-resistant DeFi assets when it comes to long-term day-to-day usage such as high-volume savings and investing or cross-border payments. Number 5 is the impact of CBDCs on the competition for Web3 talent. Though less discussed, another crucial area how the introduction of CBDCs by central banks may affect DeFi is the competition for top Web3 talent. Compared to the traditional tech industry, the Web3 talent pool is relatively small. According to a 2021 report compiled by Electric Capital, about 3,000 new developers joined Web3 every month in the last months of 2021, while Conseus is a prominent Web3 developer tool platform, revealed that just over 350,000 developers use its proprietary blockchain development infrastructure called Infura. Due to the decentralized and ubiquitous nature of the blockchain, it is quite difficult to obtain reliable headcount data on the number of the Web3 developers today. On-chain data suggests that there are less than 1 million Web3 developers globally. And to build out, deploy, and sustain their various versions of digital currencies, central banks must attract an appreciable quantity of top-quality Web3 developers. And to achieve this, they will have to compete head-to-head with existing DeFi platforms for Web3 talent. Globally, the public sector has the reputation of paying significantly less wages than the private sector. Hence, this could hamper the ability of governments to attract the best talent to build out and run their digital currency projects. While they may offer high wages, DeFi platforms are notorious for high employee turnover. Following the market downturn in May of 2022, many Web3 companies, including Coinbase, OpenSea, Gemini, and BlockFi, all announced massive layoffs by June. This reputation of job instability in the private Web3 sector could see many top talents actually turn to the public sector to work on CBDC projects in the respective countries. Financial sovereignty is one of the major premises behind the creation of CBDCs. Therefore, the development of digital currency projects would have national security implications. Consequently, central banks may be reluctant to employ non-citizens or allow employees to work remotely on sensitive government-funded projects such as CBDCs. Web3 is notably the most remote-friendly industrial subsector globally. The decentralized ethos in blockchain and cryptocurrency industry means that remote work, individualized schedules, and geographically flexibility are the norm. And it would be difficult for central banks to offer these perks while maintaining the goal of minimizing national financial stability, macroprudential, and espionage risks. Potential areas of synergy between CBDCs and DeFi. While experts on both sides of the TradFi-DeFi divide continue twittering about their differences, it is not all discord between CBDCs and DeFi. It is important to note that CBDCs and DeFi have crucial areas of synergy where government participation could positively impact the blockchain industry, leading to a win-win situation for both sides. Financial inclusion and crypto literacy. A key observation in the few CBDC pilot programs in China, Bahamas, and Nigeria is that CBDCs are widely advertised on national media channels. As a result, global rollout of CBDCs could indirectly improve crypto literacy by raising public awareness about cryptocurrencies and blockchain technology globally. Likewise, the synergy between TradFi and DeFi through CBDCs could significantly improve financial inclusion. Instant payment settlements. Today, cross-border transactions take between 2 to 10 working days, while settlements between institutions may take even longer. The introduction of CBDCs could see the accelerated application of blockchain technology to cross-border and international trade standards, leading to more efficient transactions and lower fees, and increased ease of doing business across the board. Easy on-ramping and off-ramping. CBDCs will bring down barriers to entry in the blockchain space in many countries by easing the on and off-ramping processes. The introduction of CBDCs could mean that people are now able to off-ramp and on-ramp on their local currencies with better efficiency compared to the complex international card transactions, which are often declined or cost huge transaction fees. Anti-fraud and security. Active participation of national and regional governments in DeFi will finally remove the Wild Wild West tag that has become synonymous with DeFi since its inception, and directly signal back to hackers and bad actors that it is no longer business as usual. In 2022 alone, over $1 billion has been stolen by hackers from various DeFi protocols. Government participation through CBDCs could help bring an element of authority and recourse into DeFi, which could ultimately reduce the incidence of exploits. So what are the final thoughts? Speaking earlier this year during the CBDC panel discussion at the World Economic Forum in Davos, anchor Julia Chatterley stated that if there's one thing that all financial sectors participants, including banks, regulators, DeFi businesses, and consumers agree on, is that the current financial system should be more efficient, inclusive, and less expensive. We all recognize that technology like CBDCs have the potential to reshape the global financial system and also revolutionize payments. It's going to be pretty interesting to see how governments implement digital currencies without inadvertently crowding out or stifling innovation in the DeFi sector.